So let's start. Price opened up this morning and we had this gap up, and then right here at 10:46 price broke below the 5 minute trigger. So when price breaks below the 5 minute trigger, once you have a candle close below, so that was right here, candle close below the 5 minute trigger, that's when you'd go short. So you would have went short at 400.03, and your stop loss would have been 10 cents above the 5 minute trigger. So 413 was the 5 minute trigger. Your stop loss is 424. So you're going short at 400, stop loss at 400.24. Your maximum risk is under 10%. Now, once you get short, your stop loss can be either a 1 minute candle close above the 1 minute trigger. If you're in 0 date options, if you have more time on your contracts, you could have a stop loss above the 5 minute trigger. So from here, you would have held your short. Over here, you would have held your short. If you're really good, like when I was in my prime, I probably would have added shorts right here, get even more aggressive with the trade, because remember, we're below the hourly trigger, so trend favors the bears. Get short right here, you can add or hold, 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 hold. As soon as this candle closes above, you would have been out of the trade. So you would have been short at 400, and you would have been flat at 396.87 for over a $3 move. That was the first trade of the day, an excellent short. Another way you could have exited was right here at the weekly trigger. You could have exited at 397.37. So that was the first trade. And then we have to zoom out a bit and remember that there's positive weekly velocity, and so we expect bulls to come here and step in at the weekly trigger and protect it and push price back up. If we zoom out to the velocity, we can see three clear bullish divergences. What does that mean? Here is the most extreme negative velocity print on SPY. It was put in right here on Tuesday at 13:04. And you can see price during this time was all the way up here. So we'll take this as our first low with the most extreme velocity. And then from there, price makes a new low. Obviously, velocity is not as extreme as here. So this is one bullish divergence. If this was indeed bearish, then when price made this new low, velocity would have made a new low as well. But it did not. So this marks the first bullish divergence. Price comes down, makes another new low, and velocity still has not made a new low from here. And so because velocity did not make a new low, this is your second bullish divergence. And when price makes this third low, that is your third bullish divergence. The rule of trigger signal is that once you have three bullish divergences, if price would move back above the 5 minute trigger, and especially if the 1 minute trigger crosses above the 5 minute trigger, I'll circle that right here, then you now expect a move back to the hourly trigger. Why? Because we had three. Second. Because you have three bullish divergences, once price moves back above the 5 minute trigger, and you get the 1 minute trigger crossing above the 5 minute trigger, that's when you go long. If, for example, there was no bullish divergences over here, then just because price moves back above the 5 minute trigger does not necessarily mean that it's going to come all the way back and attack this hourly trigger. There's probably about a 50-50 chance. But if there's three bullish divergences, which we knew all morning, we knew all day that we had three bullish divergences, then in that scenario, once price moves above the 5 minute trigger and closes a candle above, and especially once the 1 minute trigger crosses, that's when you can expect a chip to the hourly trigger. And pretty much in a straight line, that's exactly what happened, and we profited big time from it. Now let's get a little bit deeper. What are the specific entries? There's two entries. One entry is the first candle close above the 5 minute trigger. One entry is the first candle close above the 5 minute trigger. That happened right here at 13:39. From here, you would take your position. Price over here is 397.70. You'd take calls, and your stop loss would be 10 cents below the 5 minute trigger. The 5 minute trigger is 397.64. So you'd take calls at 397.70 with a stop loss at 397.54. Maximum loss is under 10%, if not even 5%. Over here, you could have added to your longs if you're aggressive, and as long as you have your same stop loss below the 5 minute trigger, you're fine. The second entry, which is the entry that I took, was after the trigger cross. As soon as the trigger cross happens and you have 3 hourly bullish divergences, 90% of the time you're going to see a move up to the hourly trigger. So instead of taking calls above the 5-minute trigger, I waited for a little bit of added extra confirmation. So I ended up taking my calls right here at 398, and my stop loss is 10 cents below the 5-minute trigger, which is at 397.60, because the 5-minute trigger is at 397.69. So when I buy right here at like 398-ish, or let's say it was let's just say 398, I now have a more risk monetary wise than if I bought here. If I bought here, I could only risk 20 cents. 20 cents is all I'm risking if I would get stopped out. But if I buy here at 398, I'm risking now 40 cents because I'd only get stopped out if price moves all the way back down to 397.60. So why would this right here be a better entry than here? The answer is, over here, there's still a chance that price moves up and then comes straight back through both of these triggers, the 1 and the 5-minute. But once the 1-minute trigger crosses, the odds that I'm going to end up getting stopped out for a loss are astronomically low. Why? Because the rules of anemoy are simple. If you have 3 bullish divergences, which are very, very obvious in this case. Look how price makes 3 new lows while velocity just keeps getting better. When you have 3 bullish divergences, it's already done. It's a done deal. If you get this trigger cross, 90% of the time we're talking about, it's a done deal. It's over. Price is going back to the hourly trigger no matter what. It's already been decided. The algos have already made the decision. And so although there's if you would get stopped out here, you'd take, let's say, a 17% loss or a 20% loss, as opposed to buying here on this candle, you could only maximum take a 10% loss. If you do buy here, like I did today, there's a very, very, very little chance that you'd actually end up getting stopped out, as opposed to here where there's more of a chance that you'd get stopped out. So either way, we went long right here at 398. I actually think I got my entry at like 397.90, but whatever. Of course, you can add on both these touches of the 1-minute trigger. You can add to your calls, and from there, you just ride it up. At this point, you'd have a stop loss under a candle close under the 1-minute trigger, so you would have got stopped out right here at 400. So that would have been a $2 gain in options. We already know that's over 120%, so that's excellent. But if you really trust anemoy and you trust that once you get this trigger cross with 3 bullish divergences, price is going to the hourly trigger, then you could have just held the entire time and sold at the hourly trigger. You would have been in this trade from 13.48 to 15.34. That's a 2-hour trade. Personally, I don't like being in a trade that long. I like being in for less than an hour, because then, you know, my emotions go all crazy. Like, it's a lot of money. It's flashing back and forth, up and down. I'd rather just take my money and run. I don't really care about this extra $1.50 move right here. Now, if we look at the 5-minute velocity, last thing, and then we're going to end. On this push up, you guys could see that there was no 5-minute divergences. With each new high that price made, 5-minute velocity kept going higher. Now the 1-minute velocity did diverge. You can see here, price was at 399.65, 1-minute velocity was 0.08, and then price made a push higher, 400, and 1-minute velocity did not. And so that's why we had this pullback to the 1-minute trigger. Divergence on the 1-minute time frame leads to pullbacks to the 1-minute trigger. But you could have known that the 1-minute trigger is going to hold this dip right here just by looking at the 5-minute velocity over here. Because the 5-minute velocity had 0 divergences on this move up, if price moves down to the 1-minute trigger, we are expecting it, even if it comes down a little bit, we're expecting it to push back up, which it did. Now, the last part is that here's your most extreme 5-minute print, 0.15, and price at the time was 400. So then you make one new high right here, 400.93, bearish divergence, another new high right here, 401.10, 5-minute velocity does not make a new high, bearish divergence, and your final third divergence came into the hourly trigger while hourly velocity was negative, although very slightly negative. So if price moves into the hourly trigger with 3 5-minute divergences, it's a great place to actually go short, and you could have gone short at 401.50 and taken it down all the way to 443. Now, obviously I didn't take this trade, I'm not trying to overtrade, but just showing you how velocity on the 5-minute level can help you discern whether price is going to break above the hourly trigger or not. And you know, on Discord, we said that this is likely going to be the top of the day because as price was nearing the 5-minute trigger, the hourly trigger, 5-minute velocity diverged. So that was the trade for today. Pretty simple. Just try to remember the setup, and next time you see 3 hourly divergences and price moves above the 5-minute trigger and the 1-minute trigger crosses, just know that you have a 90% chance of price is going to end up and attack this hourly trigger. So that was the play for the day.